Every major financial collapse of the past century has not emerged from chaos. It has followed a repeatable sequence, unfolding quietly long before panic ever reached the headlines. This pattern was present before 1929. It appeared again before 1987, 2000, and 2008. It is not a theory. It is a structure, a progression of pressures that builds beneath the surface while markets still appear strong. Most people never see it, because understanding it too early would change behavior too soon. Today, all 5 stages of this sequence can be identified again. The question is not whether the pattern exists. The question is how far it has already advanced, and what that implies for those still assuming stability. The origin of this framework traces back to a moment most history books reduce to a footnote. In 1929, a businessman named Roger Babson stood before an audience of executives and investors and delivered a warning that sounded absurd at the time. He said a crash was coming and that it would be severe. The room laughed. Newspapers mocked him. Irving Fisher, the most celebrated economist of that era, dismissed the idea publicly and declared that stocks had reached a permanently high plateau. Less than 2 months later, the market collapsed. Fisher lost his fortune and spent the rest of his life trying to recover. Babso, time 0.3s, by contrast, preserved his capital, built new ventures, and later founded a college that still exists today. What made this episode remarkable was not the accuracy of Babson's warning, but the reason behind it. He was not guessing. He was not relying on instinct or fear. He had developed a systematic method for analyzing financial conditions, one that focused on how credit, market structure, institutional behavior, liquidity, and vulnerabilities interact over time. 5 forces, 5 stages. Together, they formed a sequence that appeared before every major financial breakdown. To test whether this framework was coincidence or structure, historical records, Federal Reserve data, and academic research across multiple eras were examined. The result was consistent. Every major collapse followed the same progression. Not similar patterns, but the same underlying mechanics expressed through different assets and technologies. And the first stage of that sequence was always the same. It never began with greed or speculation. It began with debt. Before every major crash, credit expanded faster than the real economy could absorb it. Borrowing became easier, cheaper, and more socially acceptable. Individuals and institutions took on obligations they could not realistically service under normal conditions. That borrowed money flowed into assets, pushing prices higher. Rising prices created the illusion of wealth. That illusion encouraged even more borrowing. What looked like prosperity was, in reality, a self-reinforcing trap. In the late 1920s, this took the form of margin debt. Ordinary Americans were putting down 10% and borrowing the remaining 90% to buy stocks. By 1929, total margin debt had grown so large that it equaled the entire federal budget. Factory workers were leveraged in ways that would later resemble hedge funds. In 2007, the same mechanism appeared through mortgage debt. Banks engineered complex instruments that allowed homes to be purchased with no money down. Those mortgages were bundled into securities and distributed across the financial system, embedding leverage in places most people never saw. In 2000, the leverage showed up as corporate debt. Companies with no profits borrowed billions to fund expansion, often using their own stock as collateral. When share prices fell, the entire structure collapsed inward. The form of the debt changed, but the function remained identical. Today, the scale is larger and the visibility is lower. Official margin debt figures suggest hundreds of billions of dollars in leverage, but those numbers capture only a fraction of the exposure. Lending against securities portfolios adds hundreds of billions more. Options markets allow small amounts of capital to control enormous positions, creating trillions in notional exposure. Corporate debt has surged into the tens of trillions, much of it used not to build productive capacity, but to repurchase stock. Government debt has crossed levels that require interest payments larger than major national budgets. Measured against the size of the economy, total debt is now higher than it was before 1929, higher than before 2008, and higher than at any other point in recorded history. This is not an early warning. This is not a yellow light. The first stage of the sequence is fully active, and it has been for some time. The second stage emerges quietly from the first, and it is often misunderstood. Financial crashes do not occur simply because prices rise too far. They occur because risk becomes concentrated. When a small number of assets come to represent an outsized share of total market value, the system loses resilience. It no longer needs a broad collapse to fail. It only needs one pillar to weaken. In 1929, market leadership narrowed to a handful of glamour stocks. Radio Corporation of America became the symbol of the era. Its price rose from a few dollars to hundreds in a matter of years. Most investors did not understand radio technology or its economics. They understood only that the stock kept rising. As more money flowed into the same names, those names came to dominate the market's value. When Radio Corporation of America finally broke, it did not fall alone. The entire market followed. In 2000, concentration took a different form but followed the same logic. A small group of technology companies carried the weight of the Nasdaq. Cisco, Intel, Microsoft, and a handful of others came to represent an enormous share of total market capitalization. Investors believed diversification protected them, but diversification within a concentrated system is an illusion. When those few companies rolled over, trillions in paper wealth disappeared. In 2008, concentration was hidden rather than obvious. Risk accumulated inside the banking system. A small number of institutions held the majority of derivatives exposure. When one of them failed, the shock threatened the entire financial architecture. The collapse of Lehman Brothers was not dangerous because of its size alone. It was dangerous because of how much risk had been concentrated around it. Today, the concentration is no longer subtle. A small group of technology companies accounts for an unprecedented share of the value of the largest stock index in the world. When investors buy broad market funds, they are not purchasing hundreds of independent businesses. They are making a heavily weighted bet on a handful of firms whose valuations assume near perfection. Passive investment flows amplify this effect. Every new dollar automatically increases exposure to the largest companies, pushing their prices higher and increasing their weight even further. This mechanism works smoothly on the way up. On the way down, it reverses. Outflows sell the largest positions first. Selling creates more selling. Liquidity disappears precisely where it is needed. Moss. Time. 0.5s. Concentration turns what appears to be a diversified system into a fragile one. This is not a hypothetical risk. It is a structural condition, and it defines the second stage of the sequence. And once concentration reaches this level, the third stage is never far behind. The third stage is the one most people never see, even though it happens in plain sight. This is the period when those closest to the system begin to leave it. Not loudly, not all at once, quietly and methodically. Institutional investors, large banks, hedge funds, family offices, and corporate insiders reduce exposure long before panic appears on the surface. What makes this stage unsettling is the contrast between words and actions. Public statements remain reassuring. Fundamentals are described as strong. Long-term optimism is emphasized. Volatility is framed as noise. But behind those statements, positions are being sold, risk is being hedged, and cash is being raised. The exit does not look like fear. It looks like discipline. In 1929, some of the most powerful financial families in the United States began liquidating months before the October collapse. Bernard Baruch moved almost entirely into cash by early autumn. Joseph Kennedy sold his holdings before the crash, later attributing the decision to a moment of insight. In reality, he had access to information and networks that revealed stress building inside the banking system. While elites reduced exposure, the public continued buying. They became the liquidity that allowed others to exit. The same pattern repeated before 2008. Hedge funds began positioning against subprime mortgages well before housing prices fell. Major banks structured trades that allowed them to profit from the collapse of securities they were simultaneously selling to clients. Executives at large mortgage lenders sold personal stock holdings while publicly affirming confidence in their businesses. Retail investors, trusting those reassurances, stayed fully invested. Today, this divergence has reappeared. Corporate insider selling has reached levels rarely seen in decades. Executives and board members are selling shares of their own companies at a pace that far exceeds buying. The ratio between insider sales and insider purchases has moved to extreme levels. At the same time, retail participation has surged. passive investment flows, retirement contributions, and speculative trading accounts continue to add exposure. This is not random behavior. It is a transfer of risk from those who understand the system to those who believe the system will protect them. The third stage is not about prediction. It is about positioning. And when it becomes visible, it signals that the structure beneath the market is already under strain. From here, the sequence becomes more difficult to detect, because the fourth stage unfolds while everything still appears normal. Tast. The fourth stage is the most deceptive, because it unfolds during periods of apparent calm. Prices remain elevated. Markets continue to function. Volatility looks contained. From the outside, nothing appears broken. Yet beneath the surface, the conditions that allow markets to operate smoothly are being slowly removed. Liquidity is the invisible foundation of financial systems. When it is abundant, transactions occur easily, price movements are gradual, and shocks are absorbed. When liquidity drains away, markets do not adjust smoothly. They seize. Small disturbances produce outsized reactions. Prices gap instead of move. Feedback loops replace orderly trading. This stage has appeared before in remarkably similar ways. In the late 1920s, the Federal Reserve raised interest rates in an attempt to restrain speculation. Credit conditions tightened. Liquidity was withdrawn from the system. For a time, markets continued to rise, reinforcing the belief that tightening did not matter. Then, selling began, and buyers vanished. The market did not decline slowly. It collapsed, because there was no liquidity left to support prices. The same pattern reemerged in 2007 and 2008. Monetary conditions tightened, credit availability narrowed, yet asset prices remained elevated. Housing appeared stable. Equity markets held their ground. When stress finally surfaced, liquidity disappeared almost instantly. Institutions failed not because assets suddenly lost value, but because they could no longer be sold without triggering collapse. Today, the same conditions are forming again. Interest rates have been raised at one of the fastest paces in modern history. Quantitative tightening has removed vast amounts of capital from the financial system. Yet, markets remain near historic highs. This has led many to conclude that tightening no longer has consequences. That conclusion misunderstands the role of liquidity. Signs of strain have already appeared. Multiple banks failed within days, not because of credit losses, but because rising rates exposed liquidity mismatches. Emergency lending programs were introduced to stabilize the system, temporarily masking deeper structural issues. Even the market for government debt, the most liquid market in the world, has shown moments of stress where normal functioning faltered. This is the liquidity illusion. Everything looks stable until it is not. And once liquidity is gone, it does not return quickly. When this stage is active, the system becomes vulnerable to forces that would otherwise be insignificant. At that point, the sequence reaches its final phase. The fifth stage is the one no model can forecast and no authority can control. It is the trigger. This is the moment when a system that has already been weakened finally breaks. Contrary to popular belief, the trigger does not cause the collapse. It reveals it. The damage is done by the earlier stages: excessive debt, extreme concentration, quiet exits by informed actors, a gradual drain of liquidity. The trigger simply determines when the failure becomes visible. In 1929, the spark came from a seemingly minor event overseas. A British financier was arrested for fraud. The case appeared irrelevant to the American market. But British banks with exposure were forced to raise cash. They sold American assets. That selling led to more selling. Within weeks, a global depression began. The event itself was small. The system's fragility was not. In 2008, the trigger carried a familiar name. Lehman Brothers failed, but it could just as easily have been another institution. The system was already primed to collapse. Lehman was not the cause. It was the match. Triggers are unpredictable by nature. They can be geopolitical, financier, time, 0.3s, political, or entirely unexpected. A regional conflict, a sovereign debt failure, a derivatives counterparty collapsing, stress in commercial real estate, a banking run, a policy mistake, or something few are even watching. History shows that the trigger is rarely the risk that dominates headlines. It is usually the one dismissed as irrelevant. What matters is not identifying the trigger in advance, but recognizing the environment in which any trigger becomes dangerous. When all prior stages are active, timing compresses, historically, once those conditions allig. Time 0.3s. The final event follows within a relatively short window. Not immediately, but soon enough to surprise those who assumed stability. This does not mean collapse happens tomorrow. Markets can remain detached from reality longer than logic would suggest. It does not mean panic is a strategy. What it means is that the structural conditions that preceded every major financial breakdown of the last century are now present again. Those who suffered the most in past crashes were not unintelligent. They were unprepared. They trusted assurances. They assumed warnings would be obvious. They believed the system would protect them. It never deceived. Time 0.5s. The warning has never been a headline. It has always been the pattern. The final distinction in every historical collapse has never been intelligence. It has been preparedness. In 1929, Irving Fisher was widely regarded as one of the most brilliant economists of his generation. He understood theory. He understood data. What he did not respect was pattern. Roger Babson did. While most participants remained fully exposed, Babson held cash and tangible assets. When the collapse arrived, one man lost everything. The other endured. The same divide appeared in every crisis that followed. Those who assumed stability persisted because it always had before were forced to react under pressure. Those who recognized structural signals adjusted before urgency replaced choice. This difference had nothing to do with fear or prediction. It was the result of attention. History does not repeat because people forget dates. It repeats because systems behave the same way when incentives, leverage, and concentration align. The individuals caught in each collapse are different. The mechanism is not. The sequence unfolds quietly, then suddenly, then completely. The people who are damaged most severely by financial breakdowns are not reckless. They are compliant. They believe warnings would be clear. They assume someone would intervene. They trust that modern systems are more advanced, more resilient, more protected than those of the past. Every generation believes this. Every generation is eventually proven wrong. The purpose of studying patterns is not to predict a moment. It is to recognize a condition. When that condition is present, the risk no longer belongs to theory. It belongs to positioning. The system does not announce when it becomes unstable. It only reveals itself after the fact. The warning has never been hidden. It has simply been ignored.